Price moves up first, but it cannot keep distance. The session forms inside compressed memory. April 28th Asia session forms around the upper boundary of April 28th US session box. It forms with almost half compression. The range is narrow. The reaction space is thin. Price is not starting from open space. It is starting inside pressure. That matters. When a session forms around another session upper boundary, the move can lift fast, but it can also fail fast. The box is already close to decision. You cannot chase every green candle. You need the lower boundary to hold. You need price to move away. You need the reaction to stay shallow. April 28th Asia session first builds near April 28th US session upper boundary. Then price moves up. It breaks above April 27th Asia session upper boundary. That first break looks strong, but the break must stay. Price must create distance. Price must not fall back inside immediately. It continues. It breaks above April 27th US session lower boundary. Then it breaks above April 27th US session midpoint. Now the move has reached deeper memory. It is no longer just bouncing. It is trying to cross the prior US structure. That is where most traders get pulled in late. The candles look strong. The move looks alive. The distance already traveled looks convincing. But the trade is not created at the top. The trade is created at the lower boundary. April 28th Asia session gives the long setup. Long entry line. April 28th Asia session lower boundary. Stop loss line. April 21st US session midpoint. Take profit line. April 27th Asia session upper boundary. The first target sits at the upper boundary of April 27th Asia session box. Price already reacted around that structure. If the April 28th Asia lower boundary holds, the first real test above is April 27th Asia upper boundary. So the target goes there. Not beyond it. Not because we hope for more. The entry sits at April 28th Asia session lower boundary. Why there? Because the session forms compressed. A midpoint entry becomes weak. The box is too thin. Price can cross the midpoint several times. That does not give clean control. The lower boundary is different. If price holds the lower boundary, sellers fail to break the box. If price moves away from the lower boundary, buyers can build the next leg. That is where the long begins. Now the stop matters. There are closer options. You can use April 28th US session lower boundary. You can use April 21st US session upper boundary. Those stops look better. The ratio looks cleaner. The distance looks smaller. But the chart already gave warning. During April 28th US session, hourly candles already touched the lower side. The market already tested that area. A stop placed too close to a tested level can get touched again. That touch may not break the larger idea. It may only be normal pressure. You are right about direction, but the position is gone. So the safer stop sits lower. April 21st US session midpoint. That line gives more depth. It gives the long enough room. It avoids the already tested upper noise. It does not chase the prettiest number. It protects the structure. If price reaches below April 21st US session midpoint, the lower memory is no longer holding. The long has failed. That is real invalidation. Not discomfort. Not noise. Real failure. Price moves upward from the entry area. It reaches April 27th Asia session upper boundary. The first target is paid, but price continues to push. Now you consider trailing. First trailing target, April 17th US session upper boundary. Price has moved away from entry. The trade has earned distance, so the target can move higher. but the stop must move too. Target cannot move alone. If you move only the target, you are not managing. You are hoping. If you move the stop too tight, normal reaction removes you. Then the original trade pays more than the trailed trade. That happens often. So the stop must follow. But it must follow with room. Price moves again. It pushes into older upper memory. Second trailing target. April 27th U.S. session lower boundary. Risk-reward ratio. 2.55. That second trail only works after proof. Price must hold above the first target. Price must not return fast. Price must keep distance. If price cannot hold above April 27th Asia upper boundary, the trail should not expand. If price moves away and pullbacks stay controlled, the trail can continue, but the stop must still protect the earned move. If the stop moves with enough room, but still does not pass the entry line, trailing may not help. Then you do not trail. You either take the first target, or you keep the original plan. A trail must improve the trade. It must protect profit. It must reduce open risk. If it does not do that, it only creates confusion. Now look at the full path. April 28th Asia session forms compressed around April 28th U.S. upper boundary. Price breaks above April 27th Asia upper boundary. It breaks above April 27th U.S. lower boundary. It breaks above April 27th U.S. midpoint. It tries to test April 27th U.S. upper boundary. Then the move weakens. Price cannot keep distance. It falls back. It breaks below April 27th U.S. lower boundary. It returns to test April 27th Asia upper boundary. That return matters. The higher move did not stay. The breakout did not keep control. The market returns to the earlier target zone. So the long must be managed. You cannot treat a failed upper push as unlimited continuation. The trade was good, but it had to be controlled. Entry came from lower boundary holding. Stop came from deeper session memory. Target came from the next upper boundary. Trailing came only after movement was earned. That is the method. Not chasing, not guessing, not buying because price goes up. You wait for the lower boundary. You watch sellers fail. You enter when price moves away. You protect below real failure. You take profit at memory. Then you trail only when the trade earns it. Price reaches. It reacts. It holds or fails. Then you act. Price forms high, but it breaks down fast. The session forms between two upper memories. April 29th U.S. session forms exactly between April 17th U.S. session upper boundary and April 28th U.S. session upper boundary. It fits into that space. The location is important. Price is not starting from open air. It starts between old resistance and recent upper memory. The box forms near pressure. That means the first move can be violent. It can break down quickly. It can also snap back. So execution needs caution. April 29th U.S. session begins near that upper zone. Then price drops. It breaks below April 28th U.S. session upper boundary. That first break matters. But you do not chase immediately. You wait for the next test. Price continues lower. It breaks below April 28th U.S. session lower boundary. Now the whole April 28th U.S. box is lost. The move has pressure. Then price drops again. It breaks below April 21st U.S. session upper boundary. Then it breaks below April 21st U.S. session lower boundary. Now the drop has moved through another box. It is no longer only a local failure. It is moving through layered session memory. Price continues. It breaks below April 20th U.S. session upper boundary. Then it reaches April 20th U.S. session midpoint. It tests. It slows. That is the deeper objective. Now the short setup must be separated from the drop itself. You do not short because price is already falling. You short where the structure loses balance. April 29th setup gives the short. Short entry line. April 27th U.S. session lower boundary. Stop loss line. April 24th U.S. session midpoint. Take profit line. April 28th U.S. session lower boundary. First trailing target. April 21st U.S. session lower boundary. Second trailing target. April 20th U.S. session lower boundary. Risk-reward ratio 3.13. The entry sits at April 27th U.S. session lower boundary. Why there? Because price had already failed above. The April 28th move tried to push higher. It could not keep control. When price returns below April 27th U.S. lower boundary, the prior structure loses support. That gives the short. But this setup needs caution. The short entry appears right before the April 29th U.S. session basis candle. That matters. Right before a new session basis candle forms, the market can reset. The new box can change everything. Liquidity can shift. A level that looked like failure can become the new session origin. So this entry cannot be treated casually. Even when the structure looks right, timing can make the trade dangerous. Before the new U.S. session basis candle, price can move quickly in both directions. It can trap early shorts. It can sweep the boundary. Then it can continue lower, or it can reverse into the new session. That is why entering right before a basis candle is not preferred. If you take the trade, you reduce risk. If you want safer execution, you wait for the new session to form. Then you trade the new structure. Now the stop decision. There are two options. First option, April 27th U.S. session upper boundary. Second option, April 24th U.S. session upper boundary. But the chosen stop sits at April 24th U.S. session midpoint. Why? Because April 28th Asia session hourly candles already tried to test April 27th U.S. session upper boundary. That line already attracted pressure. If you place the stop too close to that area, price can touch it again. The short can still be valid. But you are out. The April 27th U.S. upper boundary looks logical. It also looks closer, but it may not give enough room. The safer stop must sit where the short really loses control. April 24th U.S. session midpoint gives that room. If price returns toward that midpoint, the downside break is no longer clean. The short has lost too much control. That is where you leave. Not because the ratio looks worse, because survival matters. Now the target. The first take profit line sits at April 28th U.S. session lower boundary. Why there? Because price broke below April 28th U.S. upper boundary. Then it broke below April 28th U.S. lower boundary. When price returns through that box, the lower boundary becomes the first objective. The move does not need to collapse. It only needs to complete the failed April 28th box. That is the first target. Price drops. It reaches the target area. The short pays. Now the question changes. Take profit or trail. Trailing starts only after the trade earns distance. First trailing target, April 21st U.S. session lower boundary. The price has already moved through April 28th US box. Now it reaches toward older memory. If it cannot reclaim the broken levels, the short can extend, but the stop must follow. Do not move only the target. Move the stop too. If the stop remains far above, you are giving back too much. If the stop is too tight, the reaction removes you. So the stop must follow structure, not emotion. Second trailing target. April 20th US session lower boundary. Risk-reward ratio, 3.13. This stage needs more proof. Price must break through. April 21st US lower boundary. It must not return above it. It must continue to make lower reactions. If price holds below that memory, the second trail can continue. If price reclaims it, the short loses pressure. The trail ends the trade. Now look at the full breakdown. April 29th US session forms between April 17th US upper boundary and April 28th US upper boundary. Price drops below April 28th US upper boundary, then below April 28th US lower boundary, then below April 21st US upper boundary, then below April 21st US lower boundary, then below April 20th US upper boundary. Then it tests April 20th US midpoint. That is a layered failure. But the trade still needs discipline. The entry was not risk-free. It appeared near the new US session basis candle. That is a timing problem. A good structure can become a bad trade if the timing is weak. So the method must include timing. Do not enter automatically right before a session basis candle. Wait if the session is about to reset. Let the new box form. Then use its upper, midpoint, and lower lines. If you still take the setup early, size must be smaller. The stop must be wider enough. The target must be realistic. Now connect Part 1 and Part 2. Part 1 gave the long. April 28th, Asia lower boundary held. Price moved up into older memory. Trailing could extend only after proof. Part 2 gave the short. April 29th US area failed from upper memory. Price broke down through multiple boxes. But the entry required caution because it came right before the new session basis. Same market, opposite trades. Not because opinion changed, because behavior changed. Long starts when lower memory holds. Short starts when upper memory fails. Stop changes when a level was already tested. Target changes when the next box is reached. Trailing changes only when price earns distance. Now the final rule. Price reaches. It reacts. It stays or fails. If lower memory holds, long can build. If upper memory fails, short can form. If the entry comes before a new session basis, wait or reduce risk. If the stop sits on a tested line, move it to real failure. If trailing does not protect profit, do not trail. The chart offers movement, but movement is not enough. The trade needs location. The trade needs timing. The trade needs survival. Only then does the structure become executable.